with Roger Morris, and he's sales director from Precise Mortgages. Without the superhero cutouts this year, I was a bit disappointed that that's not here, Roger.
No, our fan base is also disappointed, but we feel we've got to move on and evolve. So the superheroes were last year. This year it's the home of specialist lending.
Something new. Well, listen, with regards to what's going on with the buy-to-let rates at the moment, being driven down towards the end of last year, do you think it's a competitive market still? What do you think's happening?
What you've actually got to look at is the amount of entrants and people operating in the buy-to-let sector. So at the height of the market, when we were 48 billion in 2007, to where the market is today at about 28 billion, the amount of lenders in the market now are at an all-time high of 67 lenders, and in 2007 it was 57. So there's more lenders, more people looking for the non-regulated, low-risk type of business, and the competition on rates is predominantly at the 75% bracket, not the 80 or the 85. So we're going to see the buy-to-let sector grow above 30 billion this year, and we're going to see rates drop and competition for the market increase.
And do you think the pension changes will affect the buy-to-let market at all?
Definitive, without a doubt. So look at policy and credit. I would say the definitive point was TMW's term to 105. So as long as the application is still 70 or below, you can get a 35-year term. Precise has gone to an 85-year term, but allowing a remortgage to 79 to take into account this huge part of the market. 60% of Precise's buy-to-let applications are from the self-employed. So it goes to show the government's message of you need a pension into retirement has come through, and a pension is possibly the pension requirements. A buy-to-let is the most structured investment vehicle that you can have for a pension that you actually control and doesn't devalue. So I would say the pension market having its changes, but not as dramatic as we think. I think it's more of a marketing message than a flood of money coming out. Because if you had £400,000 and you had to take it out of your pension, you'd pay 55% on that 400, so it wouldn't make sense. But I think the lump sum will be used to stimulate the buy-to-let market further.
And do you think, with regards to a lot of people being cautious, a lot of cautious lending over the years, do you think the market's beginning to innovate to cater to borrowers now with kind of like less black and white circumstances?
Yeah, I think what you've got is the challenger banks and the building society have really taken up that gauntlet, and across the market, whether it be Precise, Aldermore, Kensington, Shawbrook, have actually really started to stimulate some innovation. The building societies have gone back to manual underwriting and moved away from the automated decision. And the big five have been caught asleep. And what we'll see is the reason that the big five are losing their share of lending is because the much smaller lenders are much leaner, faster, and can react to market needs.
Thank you very much for joining us. Enjoy the rest of the expo.